You buy a business, you run it hard, then you shut the doors, hand back the keys, and discover you still owe hundreds of thousands of dollars. Personally, the business is gone. The loan is not. Most buyers picture the worst case as losing the business. The actual worst case is losing the business and then spending the next decade paying for it anyway. That is what a personal guarantee does, and most people who sign one do not fully understand what they have agreed to until it is too late to change it. Today, we cover the 4 things nobody tells you about personal guarantees before you borrow money to buy a business. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. When a buyer sits down to evaluate a business, they spend most of their time on the deal itself. The revenue, the cash flow, the purchase price, the projections. That is the right work. But there is a second conversation that does not get nearly enough attention, and it is the one that matters most if anything goes wrong. That conversation is about the personal guarantee. The personal guarantee is the document that connects you personally to the loan the business is taking on. Not as a formality, not as a technicality buried in the closing package. As a legal obligation that survives the business, survives a default, and can follow you for years after the company no longer exists. Most buyers assume the business is the borrower, the business signed the note, the business owns the assets. If the business fails, the lender takes the assets and the matter is resolved. That assumption is wrong. And the gap between that assumption and what the guarantee actually says is where the real financial damage lives. Here are the 4 things nobody tells you about personal guarantees before you borrow money to buy a business. Number 1, the business isn't the borrower. Number 2, the assets won't save you. Number 3, everything gets personal. Number 4, the risk you should actually measure. Number 1 is, the business isn't the borrower. This is the misconception that creates most of the confusion, and it starts with how buyers think about business structure. You form an LLC, you buy the business through the entity, the loan goes to the entity. So the entity is the borrower and you are the owner, legally protected. That is the logic most buyers carry into a closing. SBA loans do not work that way. Any owner holding 20% or more of a business that takes an SBA 7A loan is required to sign a personal guarantee. That is a program requirement, not a negotiating point. Your LLC does not absorb the obligation. Your corporate structure does not shield you. You sign personally, and you are personally on the hook for the full amount. In the scenario we are walking through today, a buyer purchases a local HVAC company. Purchase price, $900,000. SBA 7A loan, $810,000. 10% equity injection of $90,000 from the buyer. The personal guarantee covers the full loan amount, $810,000. The buyer's name is on that document, not just the company's. Before you sign anything, understand that your corporate structure is not a firewall between you and the loan. For SBA borrowers, it never was. Number 2 is, the assets won't save you. This is where most buyers make the second critical mistake. They acknowledge the personal guarantee exists, but they reason their way around it. The business has assets, trucks, equipment, inventory, receivables. If something goes wrong, the lender liquidates the assets and most of the loan gets covered. The personal exposure is a residual number. Manageable. That is not how it works. When business assets are sold in a default scenario, they do not sell at book value. They do not sell at what you paid for them. They do not sell at what the balance sheet says they are worth. They go to auction. And auction prices on business equipment, vehicles, and leasehold improvements are a fraction of any reasonable valuation. The sign you paid $40,000 to design and install sells for hundreds, not thousands. The commercial equipment, the custom build-out, the branded vehicles, pennies on the dollar every time. Back to the HVAC scenario. The business closes. The lender moves to liquidate trucks, equipment, inventory, outstanding receivables. Everything goes. Total auction proceeds, $310,000. Now, the original loan was $810,000. The buyer has been making payments, so the outstanding balance at the time of default is lower than that original amount, depending on how far into the loan term the failure occurred. Whatever that remaining balance is, $310,000 in auction proceeds is not going to cover it. The gap between what the assets recover and what the loan still owes is owed personally. In this scenario, that gap is approximately $500,000 net of principal payments made. That amount does not disappear because the business is gone. It is owed personally under the guarantee signed at closing. There is one more thing buyers and owners frequently do not know about this stage. In many SBA loan defaults, the lender files a lien on the borrower's personal residence. This does not happen in every situation, and the specifics vary, but the possibility is real and worth understanding before you are in it. The business closes, time passes, you get back on your feet. You go to sell your home years later, and the lien surfaces at closing. It has been sitting there the whole time. It has to be paid off before the transaction can proceed. The point is not to walk through every rule around liens. The point is to know this can happen and to ask the question before you sign, not after. Number 3 is everything gets personal. The first 2 items explain the mechanics. This one explains what it actually means for your life. When the business closes and a substantial balance is still owed personally, the problem is no longer a business problem. It is a household financial event. Personal savings gone, future income directed toward a debt that the business created but can no longer service. Other personal assets potentially in reach, future borrowing capacity affected. The ability to refinance a mortgage, qualify for a car loan, open a line of credit. All of it tied to a balance sheet that now includes a 6-figure personal debt from a business that no longer exists. And if a spouse held any ownership stake in the business, their position is not automatically protected. The 20% ownership threshold that triggers the guarantee requirement applies to combined ownership as well. A household that owns the business together is a household that can be exposed together. Most buyers and owners never have this conversation before closing because the business looks good, the projections hold up, and the guarantee feels like a formality. The discipline is to have the conversation anyway, to walk through the worst case as a household financial event and ask whether you can absorb it, not just whether the business can. Number 4 is the risk you should actually measure. The question most buyers ask before signing is, can this business afford the loan? That is a necessary question. It is not sufficient. The right question is, if this business fails in the next 24 months, what does my household financial picture look like? Walk through it directly. What savings are committed to this deal and would be gone? What personal assets are exposed under the guarantee? What does a substantial personal liability do to your family's finances for the next 5 years? What happens to the home if the lender pursues the residence? What does this do to your ability to borrow money, change careers, or recover financially? Most lenders require that business cash flow cover the debt payment by at least 25% before they will approve the loan. That cushion exists because revenue is never perfectly stable. Buyers and owners should apply the same logic to their personal exposure, not just whether the business can service the debt in a good year, but whether the household can survive the guarantee in a bad one. If you cannot answer that question clearly before you sign, you have not finished evaluating the deal. Here is what to take away from this video. First, SBA 7A. Loans require an unconditional personal guarantee from any owner with 20% or more ownership. Your LLC does not protect you. Second, when a business fails, assets sell at auction for a fraction of their stated value. In the scenario we covered today, $810,000 in original loan proceeds produced $310,000 in liquidation recovery. The remaining personal balance, net of whatever principal payments had been made, was approximately $500,000. Third, lenders can file a lien on a borrower's personal residence as part of guarantee enforcement. That lien can sit dormant for years and surface when you least expect it, at the closing table on a home sale. Fourth, a personal guarantee turns a business failure into a household financial event. The exposure is not just what the business loses, it is what your family loses. Fifth, never ask whether a business can afford the loan. Ask whether you can survive the guarantee if the business cannot. If you found this useful, subscribe. We cover the numbers and the fine print that matter before and after you sign anything. Research the deal before you fund the deal,